We have with us Adhil Shetty, the CEO of bankbazaar.com. Adhil, lovely having you back with us on the Money Show. Thanks so much for joining in. So Adhil, to start with, before we get into the nitty-gritties and the more granular parts of it, let's understand, first up, what have been your thoughts on the announcements made by the budget? Do you think that, this has become an event that maybe retail investors, need to pay attention to, or, need to give it a lot of significance? Do you think that was the case in Budget 2021?
So I think the budget, impacts all of us as regular taxpayers and people who are planning our savings for our family, for anything that we're looking to do, whether it's managing a home loan or the provident fund we put away, or money that we're putting in ULIPs or term insurance. So I think it is a very, very interesting day for everyone, because what is said there affects how we plan our finances for the next year. I'd love to talk about what I felt were some of the things that I, as a salaried person, took away from yesterday's budget. I think there was something interesting on Provident Fund about how contribution more than 2.5 lakh is going to be taxed. There was a very interesting point on ULIPs, where the advantage that ULIPs had over MF is going to go away if your premium is over 2.5 lakhs per annum. There was something interesting on home loan deduction. So a lot of interesting things, Mubina. And I think it's something that every taxpayer or every salaried individual should pay attention to.
Okay, we'll get to that bit on Provident Fund and ULIPs as well in more details, because it's something that will impact especially the high income earners and, the way they save for their retirement. But let's talk about the bit that, we spoke with Lakshmi as well earlier. I think the money market has been very surprised by that high borrowing figure by the government. If you could explain as to how this would impact retail debt fund holders and even for that matter, borrowers.
Fair enough, right? So I think, like you explained very well, right, in the previous segment, what has happened is the yield curve has gone up. And this tends to happen because the government is borrowing significant amounts of money and has said it's going to borrow a lot of money next year, which has pushed the yield curve up. Now, the impact in terms of the debt holders, I think, was well discussed. There will be a one-day fall, but going forward, one can expect higher yields. I think we're in a very strange situation now, Mubina, because, and I'll tell you what I think people should do. So we're in a strange situation because when the government borrows more, it pushes rates up, right? But yet we're in a strange situation that the RBI has pushed a lot of liquidity and there is excess liquidity in the system. Because of this, right, fixed deposit rates, rates on various savings instruments are lower than they've been in a long, long time. I think we're in a strange situation wherein people need to continue to watch what their savings rates are. And the main takeaway, right, I think for savers is that if FD rates are going to stay so low, or if the interest you're earning on your investments, debt investments, is going to stay low, you need to rethink how much you need to put away. So if you were assuming that, you'd make 8% return and you need so much money for your retirement corpus, I think you need to recalculate now in light of prevailing low rates. Now, if we see interest rates start to go up, which might not happen because liquidity is so high. But if we see interest rate go up, I think a lot of home loan borrowers, right, are seeing the lowest rate in the last 15 years, where all of our EMIs are at the lowest they've been in a long, long time. If rates go up, I think we should be ready to fork out more or pay more in terms of our EMIs on our home loans and the other loans we're carrying.
Okay, that is in a scenario where interest rates go up. But Adhil, do you think that we could be seeing that in this year, in the year 2021, or do you think that, for now, interest rates will stay low, at least for this year?
We do believe so, Mubina. I think that while no one has a crystal ball and no one can predict very, very clearly, I think the sense we get is the government is trying to get demand up. Home loan purchases have started, car loan purchases have started. We've seen credit card spend increase to pre-COVID level. So the general sense, right, is that this accommodative or open environment is going to stay, and that interest rate or the repo rate is going to stay where it's at for some time. But the caveat I should place, right, is that no one knows exactly what will happen. But the general sense is we're hoping that the repo rate continues to stay at 4%. And these very low rates on home loans, right? Today we're seeing home loans start from 6.7%. There's a lot of interest where people are saying that, oh, I'm paying 8% on my old home loan, but if I refinance it now, I'm getting it at less than 7%. We believe that those low repo rate will continue, but no one knows exactly what will happen in the future.
Yeah, of course, understandably, but the idea is just to understand what exactly is happening in the macro scenario, which a lot of retail borrowers, investors do tend to ignore. But yeah, sometimes when you understand what exactly is happening in the environment, in the macro environment around you, you can sort of, apply that to how that will impact other variables that affect you and your money directly. The most important variable being the interest rate, because that impacts debt fund holders, that impacts people who are paying off their loans, that impacts even, in fact, those people who have money deposited in a bank via an FD, which is, I think, a majority of the Indian population. So I think that's the reason why we should sort of always be aware, and that's the reason why we on the Money Show as well do tend to have these sessions. Okay, let's get into the granular bit. Adhil, the first thing that you spoke about was the Provident Fund bit, the ULIP bit. Now, it clearly says, in the case of a Provident Fund, let's focus on that. In the case of a Provident Fund, it clearly says that if your contribution is more than 2.5 lakh rupees, it's on that balance amount that there will be a tax element. Now, last year's Provident Fund gave us an 8.5% interest rate. So partially there will be tax, and obviously it will be in the highest tax bracket, because we'll assume that if you can afford to contribute 2.5 lakhs to your Provident Fund, which means you may be in the highest tax slab itself. Do you think that it reduces the attractiveness of Provident Fund as a retirement option compared to all the others we have out there?
Yeah, so that's a great question.
Like an NPS, right? Maybe?
Yeah, that's a great question. Let me just give you 2 data points if you answer the question. So firstly, right, we ran a simulation and we put together a table at Bank Bazaar which says that let's imagine you're contributing 3 lakhs a year to Provident Fund. Now, like you rightly pointed out, up to 2.5 lakh, right, nothing changes. But on the interest you earn above 2.5 lakh, now you start paying tax at the prevailing rate. So our calculation actually showed us, Mubina, that if you're paying 3 lakhs as Provident Fund, the extra tax implication for you is 1,250 rupees because of this change. So that's the quantum because of the additional tax above 2.5 lakh. Now, you pointed out that we're earning 8.5% currently on Provident Fund. Now, if you're in the 30% tax bracket, right, it pulls your return above 2.5 lakh. It pulls your return down to 5.9%. So yes, for people who are contributing above 2.5 lakh, who are earning that much, this makes Provident Fund less attractive above 2.5 lakh personal contribution. Now, what does that mean? It automatically means that other instruments start to become more attractive. So we're recommending that people look at using NPS, that people look at using equity index funds, especially if they have a long-term horizon for saving, because 8.5% effectively, right, for the amount contributed by you above 2.5 lakh has now become 5.9%.
Okay, understood. And if we have to, if I have to compare this with maybe an NPS or a PPF. Now, in an NPS, it's a very peculiar product because, you you have to pay tax only after retirement. So if let's say I'm 30 years old, I will start my annuity at 60 or 65. So it's only then that I have to pay my taxes. So do you think now that, and of course then you have that 2 lakh rupee extra deduction as well that's available under Section 80C. So in terms of return potential, in terms of tax efficiency, do you think that would perhaps now get that advantage compared to an EPF? There's no maximum limit as well for an NPS.
Yeah. It now becomes more attractive, right? Because what happened on Feb 1st was that a certain benefit that was available where interest wasn't taxable, now that interest is taxable for anything invested above 2.5 lakh. Automatically, this option becomes slightly less attractive, which automatically means that other options, like you pointed out, NPS has significant benefit. However, it's less liquid. We're also recommending that people look at equity index mutual fund because they could, if their horizon is long enough, right, make good returns as the market or the index continues to grow. So yes, all other options now become incrementally or marginally more attractive, given that this constraint has now been placed on Provident Fund.
Let's understand that point on ULIP as well, Adhil, before, I'll invite our viewers as well for questions. Because, the idea is to basically bring it on par with equity mutual funds. So if, let's say, I'm contributing above a certain amount, would it make sense then for me to put it maybe in an ELSS, which will also give me, tax benefits?
Does make sense, and I think you summarized it well. So what happened with the equity mutual fund is when you held it more than a year, you ended up paying long-term capital gains of 10%. Now, this was not there for ULIP, but basis the change that's been made on Feb 1st, ULIPs with annual premium above 2.5 lakh, right, now will incur long-term capital gains. So in simple terms, think of it as a normalization between those ULIPs with premium above 2.5 lakh and your mutual fund, which makes their long-term capital gain treatment equal. So the inference, right, is that this is a good time for you to look at your insurance strategy. We've always been saying, right, that the key to insurance is you should have a term life cover of 10 times of your income. Because the main thing you're trying to protect against is you die, right? You die and your family has a loss of income. So we say always take 10 times of your annual income as your term insurance. So I think it's a good time for you to just take a look at your insurance strategy. Ask yourself question number one, do I have a term insurance cover of 10 times of my annual income? If you don't have it, buy it now, right? Because the younger you are, the less you pay and you lock in your premium for the rest of your life. And secondly, right, once the term insurance is taken care of, given that the differential between mutual fund and LTCG is gone, you should consider mutual funds more aggressively. And the ELSS gives you the ATC, which makes it, similar to what you were trying to do with your ULIP.
Hello everyone and welcome back. You're watching The Money Show on ET Now. Well, we're in conversation with Adhil Shetty on all the announcements from, the budget 2021 and, if there are any tweaks really that you should make to your investment strategy. Let's for now open up the floor for questions, and we have a very first query coming in from Tarun Maheshwari. He says, or rather he asks, the finance minister said that more banks will be privatized. What does it mean for customers of a public sector bank? A very valid question, though, mind you, at this point of time, we've not seen too much on, the privatization front, at least for PSBs. But nevertheless, Adhil, how much of a difference really does it make from a customer point of view when a bank goes private?
Yeah, I feel that things don't change much for consumers. So there's absolutely no need to be perturbed by this. I think there are 3 points we need to note, right? So firstly, when the government talks about, some privatization, typically they continue to hold some stake in the government, some stake in the bank. Secondly, right, there is clear examples where the government has always stepped in to protect depositor money. Even in the cases of private sector banks, right, the government has always stepped in, and we have not seen anyone, lose money in deposits of a scheduled commercial bank. So I believe there's absolutely no problem here. As of now, we don't even know which are the two private sector, public sector banks which they're looking to do this in. So I would just tell the consumer, just relax. Your money is safe in a bank. They have also tweaked the deposit insurance we can talk about. So there's no cause for concern. Just wait and watch. And even with private investment coming in, right, the bank will continue to grow, and the bank and the government will continue to hold some amount of ownership in such a bank.
I guess for many people, they get this sense of assurance, when they deposit their money in a public sector bank. And I guess that's the reason why Tarun as well is asking this question. We have a related question again on banking. Very interesting announcement made by the FM yesterday. Shiva has a question with respect to that. And he quotes the FM saying, 5 lakh of the deposit insurance amount will be made available immediately if a bank fails. Approximately 2 lakh rupees of mine are stuck in PMC Bank for long. Will this help me get access to my whole money? Adhil?
So what the finance minister said that previously this amount of 5 lakh, right, which was the deposit insurance, you could only claim it when the bank was liquidated, or, the bank, everything had been shut down. It didn't apply when a moratorium came in. So when we saw a private commercial bank going into a moratorium, you couldn't make use of this insurance. What the finance minister said is that they're going to work out a scheme in which the insurance will now step in. So even if your bank only goes into moratorium, so the bank is not liquidated, the bank is not shut down, it's only gone into a moratorium, this 5 lakh insurance will kick in and will help you access your fund. So the benefit is very, very clear. However, the scheme details need to be shared. We need to evaluate, how this will kick in and how the insurance will be available in case your bank account has limits put on it or a moratorium is placed. Also, we need to see how cases like PMC will be treated, because it's not a scheduled commercial bank. It's a cooperative bank. So I think let's wait for the scheme to come out, and then we'll be able to understand clearly, right, who will get the benefit of this insurance kicking in at the time your bank account is put under moratorium or frozen. Let's wait for the details to come out from the finance ministry.
Well, yeah, let's wait. She's just made that initial announcement. I'm sure there are going to be many more details and, lots of, conditions, etc., that will be put forward as well. But Adhil, we're completely out of time. So thank you so much for joining us. We're still getting a lot of questions, but, maybe we'll sort of repeat this interview once again to get all of that answered. Thank you so much, Adhil, once again for joining in.